Hey guys, my name is Aliyu Justonia. Today is day 6 of 30-day series where I promise to teach you forex trading from zero to hero using the ICT trading concept completely free. In today's lesson, we are going to learn about liquidity. Liquidity is one of the most important concepts in ICT trading because it explains why price move the way it does. You will understand where stop losses are placed, where institutions are likely to target, and how liquidity create high probability trading opportunities. So I think I will teach you more of stop losses when we start risk management. So don't worry. Once you understand liquidity, you will start to see the market from a completely different perspective. So let's dive in. So let me start with even what is this liquidity that I'm talking about. So liquidity is where money is resting in the market. In simple terms, liquidity is the area on the chart where many traders have placed their stop losses. I told you I will teach you about stop losses when we start risk management. Or pending orders, big players like banks, institutions move price toward these areas to trigger these orders and get enough volume to enter or exit trades. Liquidity is the fuel of price movement. See, let me just tell you in simple term. This liquidity that I'm talking about is just money. Yes, just take it as like that. That I'm just money. Because every situation, for example, schools, they name money as what? Fees, right? If somebody kidnap you, God forbid, they call that money ransom, right? So in so many aspects, like they name money based on the way they want it to be. So in these terms, like in financial market terms, they name money as liquidity. Like market is looking for money. That's it. That's what liquidity is in simple terms. So let's go back to our course outline. We have classification of liquidities. We have what? External range liquidity, and we have internal range liquidity. I'm going to explain both of them. So now you should remember about the class that I taught you, what? Dealing range. Dealing range, I think it is our yesterday's class. So let me just come and quickly draw our dealing range here. Sorry, let's draw a dealing range here. Yeah. So from market structure, we have what here? We have break up structure here, right? And what? Let's assume here is an order block or what? Um, one of the ICT institutional reference point. So let's assume this is an order block where we will be waiting for market to come back for us to buy from. So let's just rename it as like this thing. So here is our what? Dealing range, right? This is our dealing range from here to here, from here to here. So where is it? Okay. External range liquidity is a liquidity that we can find it outside our dealing range. That means where? Let me see if I can get some emoji here. I'm looking for money emoji. I do not get it. Where is money emoji? Emoji for money. So this money emoji is going to waste my time. So let's assume here any liquidity that we can get here is what? Is an external range liquidity. Any liquidity that we can find outside what? Outside our daily range. That's external liquidity. In straightforward terms, I don't want to just, waste your time. So, what is the name of those liquidities? So, this one, we call it what? Sorry. So, this liquidity, we call it what? Buy side liquidity. And this one, we call it what? Sell side liquidity. So those are the what? External range liquidity. The reason why we call this buy side liquidity is because we are expecting market to be buying till it eat this liquidity, till it grab it. So it is buyers that will grab this liquidity. After buyers grab this liquidity, then they will start selling. Then sellers will step in and start selling till they grab what? This sell side liquidity. So that's why we name this buy side. Somebody might be confused. Why do you name this buy side and why do you name this sell side? Because here is buyer's zone, right? So why can't this be sell side buy side liquidity and this sell side liquidity? No, that's not how it works. We name this buy side liquidity is because it is buyers that will come and eat this liquidity. And we name this sell side liquidity is because of what? It is sellers that will eat this liquidity. So these are the simple terms of yes, simple term of, let me quickly delete this, simple term of external range liquidity. So then the next one is what? The next one is internal, as you can see, buy side and sell side liquidity. Then the next one is what? Internal range liquidity. So internal range, it has its own classification. That's where we are going to waste much time. So internal range liquidity is the type of liquidity that you are going to get it where? You are going to get it inside what? Inside your daily range, inside from here to here. Any what that you saw here, any liquidity that you saw here, it is internal range liquidity. But any liquidity that is outside here is what? It was external range liquidity. So let's dissect the internal range liquidity. So from here, as you can see, I we have what? Trend line liquidity. So what is this trend line liquidity? Trend line liquidity is a type of liquidity that is doing something like this. As you can see, this market, it create this what? Impulsive movement. So and then it start retracing. We are expecting this market to come back here. Then we what? We will start selling to here. But instead of market to come back to our point of interest, when it start coming, then the market will do something like this, will reverse. That's where uninformed traders will thought, market is going to leave. Let me just go quickly and grab the market. Then from there, market will just do something like this. You thought market will continue buying, something like this. Then from there, market will just come and clear you and eat your money, just clear you out of the market and tapped into the other block, the actual point of interest, then it will start buying from there. So those of you that are still learning, that this is their first time of, enrolling themselves to trading, you will experience something like this, that you are waiting for market, and then from there market will just, it do not reach your point of interest, then it will turn back and try to buy. If it is sell, it will try to sell. Then maybe you will follow the market thinking maybe you are catching the trade, then market will just come back and hit your stop loss. As I told you earlier, I will explain stop loss more when we start risk management. It will just hit your stop loss if you do not put your stop loss, because we are expecting to put your stop loss here. So if you do not put your stop loss, it will just come and blow your account. That means to finish everything. Maybe your family house that you sell and start trading, or your family farm, or your family anything that you sell, or maybe you even sell you one of your kidney to start trading. So it will just come and finish that your kidney that you sell. Yes, this is what we call what? Trend line liquidity. The next thing is we have what? We have equal high, equal loose liquidity. This one is a type of liquidity that, uh, let's assume something like this, still the same thing like this one. For example, market will do something like this. You are waiting for market here, then market will do something like this. But instead of creating zigzag something like this, it will just come and tap here, maybe something like this. Then from there, maybe it will just do like this, and then come back to your actual point of interest, then it will just, buy. So this type of liquidity is the type of liquidity that we call what? That we call it what? We call it equal high or equal low. Because of this equal high, that there is some strategies that they call it double bottom, or double heads. Okay, double top and double bottom. But in ICT, we call this equal highs or equal lows. That's it. So you should assume this is for buy and it's the same thing for sell. I don't want to waste time to draw sell and buy. Buy, you will just turn this upside down, and that's for sell. And the same thing for this. Yes. Then the third one is what they call inducement. Inducement. As you can see, like this movement, like it they did not reach what? They did not reach this buy side liquidity, and this one they did not reach. But in this case, in this inducement case, market will do something like this, market will come back. You are waiting for market here, market will come back and do something like this, trying to create liquidity here, something like this. Then market will break structure, something like this. And if you could remember, I told you you should what? You should always consider your what? Daily range. You don't need to consider, other structure. But in this scenario, you are going to consider what? you are not going to consider only from here. You are not going to consider here as your daily range. Here as your daily range in this scenario. You are not going to, because here you have what? Here you have what we call extreme level here and extreme order block. And you have what? Another order block here. So in this scenario, you might start thinking, which one am I going to use? If maybe you remember my lectures on dealing range, you said, Ali Justonia told me I should just use my last structure, which is this is my last structure. It breaks structure here. Then you will see something like this. Market will come back and tapped in here and start moving small. Then it will just crash and hit your stop loss, and then market will start moving. Then that's when somebody will start saying, this forex is a scam. This forex is a scam. How comes somebody tell me I should use this is my daily range and I use it and look at what market did, that and that and that. No, it is you that you are not paying attention. It is you that you are not paying attention here. So in this scenario that you are seeing, because of the presence of this equal low, that's what make this area very very weak, because there is so many money here that market will want to what? Grab it. And you that you are trying to buy from here, you will be expected to put your stop loss here. That's why in this scenario, if I wanted to catch trade such kind of trade, and maybe sometimes market might even tap in here and even dish out to reach here sometimes, because market can do anything it wants. So instead of like that, sometimes I might decide to do something like this. Maybe put my stop loss here, something like this. And to maximize my profit, I can put another pending order here. So in case if market come here, something like this. But in normal, like best practice, you shouldn't take trade from here. But in a situation whereby this did something like this, but let me just draw another one. In a situation whereby, let's assume market did something like this, come back, and did something like this. As you can see, we still have our what? We still have our own um we have our still we have extreme zone, still have our extreme zone. So in this scenario, this thing this thing is different with this. So in this scenario, as long as this break structure, you are not going to wait for market here. You are going to use this. You are going to use this. But make sure your stop loss is around here. Your stop loss cover here. That means you are going to what? You are expecting market to do something like this and give you money. So that's it. So this kind of trap, inducement is a trap that market they are creating to, swindle uninformed traders to chop their money. Yes. So, and I think we have another one. I think we have one more example of this. And there is a third scenario whereby, so, okay, here we can call this liquidity sweep. Liquidity sweep, see it here, liquidity sweep, but let me just abbreviate it, liquidity sweep. So in a situation whereby something like this, um something like this so in this scenario, as you can see, this one is the middle one that clear a liquidity, but in this case is the third one that clear a liquidity. So yeah, in this scenario too, you are going to use what? You are going to use this. You are not going to wait for market here because you might end up missing the trade. You are not going to use your extreme zone in this scenario. Where is it? Okay, extreme. In this scenario, order block. So what I'm trying to tell you that the only scenario that you are going to leave the first your first dealing range, your latest structure is when you have equal lows under or equal highs if you are trying to sell. But if it is not for that, all you have to all the times use your latest structure. Latest structure. The only scenario is to use extreme zone is if you have equal lows. So that's it for liquidity. I think this is the end of our today's class on liquidity. So our next class, in our next video, I'm going to teach you what is top-down analysis. All those things that I taught you behind is just to prepare you for what? Top-down analysis. This top-down analysis is the real thing. Oh. Everything that we learn is to prepare you for this thing, like top-down analysis. So if you have not watched my previous videos, you can go to my YouTube and my username is Aliyu underscore Gistonia. So if you would like to be seeing my content on uh, forex trading, you can subscribe to my YouTube channel. If you are not on YouTube, you can follow me on TikTok, so that you will not miss any of my class. So thank you very much for watching. So see you in my next video.